Yeah, he's helped us with some diligence on a bunch of deals, and just with what he does, he has awesome access to deal flow out of the university, so it's great. Yep. So
I wonder if we should give it a few more minutes, or people want to start introducing themselves.
And then I've known AJ for a while, who I think is one of your partners. So.
Yep. Yeah, AJ's more of an advisor, but yeah, he is involved. I was actually on the phone with him this morning.
Yeah.
Right, should we just
Yeah, I know him everywhere around
themselves, or
yeah,
may as well.
Yeah, Bonnie, why don't you call some folks out?
Well, since Michael's been here chatting away, why don't we have Michael introduce himself?
and then I'll be quiet. I promise. I'm here.
No, you are welcome to ask all kinds of questions.
I will. So my name is Michael Adler. I have my own law firm in Philadelphia. I did the big firm thing for a while, but for the last 8 years, I have my own little boutique practice, and I do business and real estate law. I work with a lot of nonprofits, and I work with a lot of artists on the business of their artists, so athletes, sculptors, painters. But I'm very involved with the entrepreneurial community of this Philadelphia area and now other communities because of COVID, because we're all geographically agnostic. So I also have a few investments myself.
Manif. Oh, you're muted right now, but introduce.
Hi. Good morning. Hi, my name is Munif. Thank you, Bonnie, for bringing me up here. And I am the founder of Integra Pitch, where we bring the inventors together with makers and have them develop intellectual property and then have it acquired by vendors or brands.
Natasha, you're muted right now, but would you like to introduce yourself? There we go.
Sure, I'll do both. Good morning. My name is Natasha Standard. I'm the owner and founder of Equal Footing. I'm in the defense industry. This is my second visit. I look forward to hearing from you all. Thank you.
Well, so what's your company do?
We make military grade combat boots in women's sizes. So for the audience that doesn't know that, all military grade boots are made in men's sizes, and then women have to grade our sizes. We have to wear additional socks. We have to wear additional insoles. The boots are not made for our feet.
Oh, put the link in the chat, because that's what I want.
Absolutely. Thank you.
Your mama wears combat boots. I remember saying that when I was a kid on the playground. So now Natasha's making combat boots. All right.
I'm out here in the country and you need combat boots. And not right now. Right now you need snowshoes, but pretty soon. So David, why don't you introduce yourself?
Right. I'm pardon me. I'm David in Baltimore. I'm partway through an education startup. I'm a retired educator working with another guy who also is, and we're developing a system to support math instruction in elementary schools.
Then Sam, up in Maine.
Okay, I'm off mute. I'm CEO of a 23-person kind of future of work platform for media. It's called Axle.ai, and I'm also advising a few other companies. Lots of interesting stuff out there, so got involved with that, and just looking forward to the call today.
And Christopher Haskell. Oh, you're muted, but there we go.
Chris here. I don't know why it's coming up as Christopher. I'm the COO at UniCrate. We're a supply chain AI platform. I do advising and consulting previous to that, and now jumping back in and trying to find companies to team up and work with as I transition out of the role at UniCrate.
And Scott Purdy, another one of our regulars.
Good morning. Yep, becoming a regular, and it's very enjoyable. Scott Purdy with Sine. I'm in South Jersey. We're based out of Philadelphia. Crowdsourced video movie making tool that we're developing. We just recently started with another company who's doing our AI for us. So we hope to have the total working product in a short time, and we're really looking forward to that.
Thank you. And Sean, good to see you again.
Hey, Bonnie, it's been a while. How are you? My company is called Edge with the Box. It is a platform that sits at the layer of the procurement technology stack to augment the incumbent approach to acquisition using tools from capital markets like central clearing, effectively a market tape for procurement and social networking.
And to Carlos Carter.
Yes, I'm just a inventor, just creating ideas, just raising capital for prototype stage, and just networking and learning about awesome entrepreneurs. And it's a great platform that you have.
Oh, thank you for being here.
You're welcome.
Adrian, and you're always welcome, by the way. Everybody's always welcome. Adrian Stern.
Yeah, hi Bonnie. Great to be with you all. I'm the co-founder of Reveal. We're looking to bring some efficiency to the $2 trillion creative industry by building a business operating system for content creators. Basically, we automate all the all the paperwork around creating content and creating IP. We're currently running some pilots with some Grammy-nominated musicians and multi-platinum artists, and about to raise our first round.
Oh, congratulations. I hope I'm not butchering your name, Varun Ram.
Yes, that is pretty accurate. Thank you, Bonnie, for having me. I'm Varun Ram. I'm a student at Duke University's Fuqua School of Business. I'm also a venture investor at Newstack Ventures, and I'm just excited to be part of this call.
Which fund?
Oh, Newstack Ventures. We're based out of Chicago, headed by Nick Moran.
It doesn't matter where you are anymore. So, Jessica.
Hey, sorry, 1 second. Okay, you guys can see me, cool. Hi, I'm Jessica. So I am just in talks with some friends to start a company to tackle some issues in electrical vehicles. So excited to be here and can't wait to hear more from you guys.
Thank you. And Irene Koo.
Hi, I'm Irene. I'm founder of Mama Coo. We are a food travel app. And during COVID, we took some time to gather additional user feedback to develop Mama Coo 2.0. So we're kind of working on that, have started beta testing, and hopefully we'll be launching that in the coming weeks.
What does your platform do? What is it about? What problem is it solving?
Yeah, so, well, I traveled around the world solo for a whole year, and then I couldn't believe how hard it was to find authentic restaurant recommendations. Hotels get kickbacks for giving their recommendations, guidebooks were dated, and Google, when you ask for authentic, you kind of end up getting the opposite. So we take local recommendations, interview them, and then collect their favorite hidden gems, and then we kind of package it with nice pictures and organize everything by the dishes you should try when you go to a foreign destination.
Oh, thank you.
We started with foreign, but now we're also covering some US travel destinations.
Okay, you have to. Kira. Oh, Kira Barker, do you want to introduce yourself? I guess not. So Jake Heath, you're up.
Hi, sorry.
Oh, Kira, I'm sorry, go ahead.
I'm driving, sorry. So I just struggled to get the unmute button. I'm Kyra Barker. I live in Trinidad and Tobago. By trade, I'm a marketing consultant with experience serving the Caribbean markets. And I'm also the founder of Fired Up Global, a virtual community connecting energized minds around the world to discuss diverse perspectives on culture, impact, and legacy.
Oh, thank you. Now, Jake, I'm sorry.
Hi, everybody. Morning. Yeah, so I'm a tech consultant with a software development agency called Jump Growth. Company's been in business for over 15 years. We work with startups, small businesses, mid-market companies on web and mobile app development. Happy to be here.
Mac, you want to talk about Kettlespace a little bit and what they're up to? Kettlespace is ordinarily restaurant co-working, so they've pivoted a bit right now.
Yeah, so we originally were turning hospitality spaces into places to work out of, co-working spots. Now we've kind of taken the technology that made kind of the seating possible and are helping companies kind of keep their employees safely and bring people into spaces safely. Hoping to get back to space very soon. We're expecting a lot of new opportunity. Thanks for being here, everybody.
So I'm Bonnie Halper. We do these breakfasts every 2 weeks with one investor and a small group of entrepreneurs, and everybody's welcome to, as you know, you introduce yourselves, and you're welcome to ask questions later. And I also write the weekly Startup One Stop newsletter, which seems to be going to a lot of people's junk folder now. So we still are putting it out. Look in your junk folder, it's there. And we've been hosting these breakfasts for 6 years. And as of April, we started hosting them virtually, and we will not stop because they're awesome. And this week we have Kyle, who was supposed to actually show up in person last year, but well, we know what happened. So thank you so much for joining us, Kyle. And I'm glad that we finally got to make this happen. And so tell us about the fund and about you and what you're looking for. And
yeah, sure. I'll give you a little bit of my background. So I went to Arcadia University, right outside Philly, actually. Majored in economics and political science. While I was in school, I interned for Goldman Sachs and Duff and Phelps. When I graduated, I started a company called BX3 Capital as a business advisory firm in kind of the early stage space, helping companies raise capital, set up structures, go out to market. A lot of strategy consulting was really interesting. Started that in January of 2018, sold it in October of 2019. Sold it because I really wanted to get on the fund side. I saw a lot of value in investing with the companies, a lot of value in investing in companies that were making an impact. I just found impact investing super interesting. Really can generate some good returns for LPs and make a difference in industries. So launched Backswing in January of 2020 with myself and a couple of partners in Philadelphia. As we kind of grew, we raised $30 million. We invested in 10 deals last year. We realized we really just weren't a Philly only fund. We've done a couple of deals in the Philly area, but we really span the East Coast, from Florida all the way up to Maine. We see a ton of quality deals. We've invested across industries, done healthcare technology, defense, real estate technology, beauty technology. So we've really built a diversified portfolio. We don't have a hard revenue threshold, but most of the companies we've invested in have generated $1 million in revenue, and they're valued under $20 million, either in late seed rounds or early Series A or early Series B rounds. So that's kind of been our sweet spot. On average right now, we're probably seeing about 20 different deals a week. As I said, we probably saw 1,000 deals last year and invested in 10 of them. So we're doing about 1% of the deals we see. And we're looking to put about $2.5 million to work in each quarter this year. So we're going to be fairly active in 2021. Of the companies in our portfolio, we actually had our first one get a term sheet for a potential acquisition on Saturday. So that was pretty exciting, being a year in and having a company in the portfolio who's ready to get acquired. But aside from the financial characteristics, where one of the main points of the thesis is looking for companies that are making an impact in their industry, something that's going to dynamically change the industry, the way that industry operates, not just be a participant in an industry, not just, generate some capital and sell, something that's going to make a real impact in the industry, which is one of the reasons why we're so passionate about healthcare technology. So that's kind of the high level overview of the fund.
Questions or comments or? Oh, Michael?
Sorry. Somebody else. No, I just want to. Somebody else talking?
Oh, was somebody else talking?
I'll just start, and Adrian, I think you can go next if that's okay.
Oh, I'm sorry.
Yeah, no, Kyle. I did my own due diligence back in May, as I mentioned, as we were getting started here, when a client sent me some of your documents, and I was just so impressed with someone who's kind of recent out of college, who's accomplished so much. Can you talk a little about how you've sort of built such a, a lot of people, I represent a lot of entrepreneurs. I represent a lot of folks who want to aspire to you. Can you talk a little about how you got lucky, or who you knew, or maybe a little bit of how you got to where you are so young in your career?
Yeah, sure. I don't know if I would call it luck. I think it would be the right place at the right time. So was a college golf and lacrosse player. I actually met the person who got me into Goldman, caddying on a golf course for them. And there's things that happen like that. I was fortunate to meet a lot of people there. I was fortunate to get like a really strong background in investment banking and just understand process and really how to build an organization and how to evaluate deals. And then that experience at Duff and Phelps was super strong too. So I got the opportunity to look at companies, look at how they were valued, understand the different ways of valuing businesses and figuring out their worth, which is so important in the business now. And I've always kind of been a worker. I've always been doing something, a lot of networking, a lot of targeted networking too. I've never been afraid to cold call people and reach out. You know, a lot of the capital base came from when I was at BX3. We were bringing a lot of deals to people. And early on, we weren't so successful in raising capital for a lot of those deals, just because it takes such a long time to establish those relationships with other funds and family offices and individuals. So this fund, like I said, we have it anchored by a couple family office groups that I've had some long relationships with, and then a lot of individual investors, such as Ken, who are really helpful in getting involved with deals and evaluating them, doing diligence. I often find that the individual investors, especially in this fund, have actually driven more of the diligence and the deal flow, where some of the bigger family office, more institutional investors, all they really care about is the returns. They don't care so much about what's invested in or, how it's done. They're really, really focused on returns. So I think for anybody starting a fund or, anybody having a business that they're raising capital for, having a few passionate individuals who can provide guidance and help you in your industry is super important. But like I said, I've always been a worker. I spend 8 hours a day on the phone calling people. I like to meet people face to face. I don't love email as much. I just don't think it's as personal. But that's what I've spent a lot of my short career doing. I've only been out of school for 5 years now, so I've been pretty active in 5 years.
You surround yourself with some amazing people. You've made some good choices. So that's
thank you.
Yeah.
And he's not afraid to reach out to anybody he feels he wants to talk to, and that's very important. That's always important. So, Adrian, I'm sorry.
No, you covered a bit of what I was going to ask you, but I'm really curious to how the transition from founder to investor went for you. It's something that I definitely aspire to further down the road. Definitely still on the founder side today. But I don't know, can you talk a bit about that transition and what you learned as a founder that's making you a better investor?
Yeah, sure. So as I mentioned, I like to go really fast. I like to talk to people, reach out to people. So one of the things that I kind of learned as being a founder is you can be really successful and hardworking yourself, but you need a lot of process and structure and the right people to surround yourself with. As an internal control, as a guardrail, really just to protect you and protect your interests and make sure you're evaluating things properly and looking at them. So I'd say that was the biggest difference as a founder to going to managing capital, is just putting so much more process into it, having so many more people around you on a daily basis of, hey, are we doing this the right way? Are we doing that the right way? What's the best practice? Because you're dealing with other people's money. I didn't raise any capital for my business, BX3 Capital. It was an advisory firm. So we kind of grew organically. There's about 5 employees now. So went from, 1 to 5, which is pretty good growth in a year and a half. But it's so much different when you're managing other people's money, like I said, with the process and the procedures and just making sure everything's documented and done the right way. That's one of the biggest things that's like a change, where when it's your business, I mean, you can kind of just go and, and sign clients and do this and do that. So that's one of the biggest things for me, was just the process and all the things to put around. But I don't think it's that different. I mean, we're still a startup fund. We're still going to make mistakes. We're still going to, it's similar. I mean, I'm a founder. I look at it now as I'm just a founder of a fund instead of a founder of, a company. It's not that different. I mean, we talk to startups all the time and we make mistakes too. And we tell them that. But I think it's, one of the things was with both businesses was just really understanding the things that I didn't know and getting people around me, which is still a process I'm doing every day, of people who do understand these things and can be helpful.
I wanted to ask something. Since you have been on both sides of the table and you know the process of startup, do you get very involved with your companies and not handhold every minute, but are there to be helpful and give them the lay of the land when they need it?
We do. We try and so I won't sit on the board of more than 3 companies. We have 10 in our portfolio right now, and I sit on the board of one of them. We try and leverage our LPs to sit on the boards. As far as I get involved, a lot of what we do is introductions and planning. So, like somebody needs for example, one of our companies is in the security business. We introduced them to Home Depot and Simon Property Group. Those were slam dunk introductions for them. As far as growing their business. So we do a lot on introduction side. I kind of have a feel for when companies get stuck, and that's where we like to get involved. I like to be close to them without feeling like that I'm their parent, just, and I'm not giving them any, free, call it free creativity or, ability to operate on their own. But I definitely want to be there as a soundboard and as a resource. But again, I want to be a soundboard and a resource without being overbearing, being like, oh my God, I feel like this guy's around all the time. He's just, constantly on us.
Manif, did you have a question? I thought you had yeah, I thought so.
Yes, thank you, Bonnie. I really have a small technical question, which is streamlining valuation and funding processes. I know that, companies like Gust Launch or Trust Finta would do some part of the valuation and make it easier for the investors to, onboard the founders or companies and have that transparent communication and relationship. What would be your favorite tool or, a set of tools that would make it easier for you to evaluate and then, onboard?
As far as like a physical tool or just things in like in the process or conversation?
Yeah, I mean, a technical tool like an online platform, for example, just like Gust Launch or Trust Finta, or those platform where companies can put all their information there and then investors can check on them easily.
Yeah, I think the one we see probably most often is Carta with the companies that we do invest in. I don't really make it a requirement for a company to have a platform because I know those can be expensive. We just, a year in, we just contracted with VMS Consulting. They're based in New Jersey. They work with a lot of funds in the Philly and New York area. But I mean, even for us, a relatively small fund, it's going to cost us about $25,000 a year. So for a startup that's relatively cash strapped, I think it's a good option, but I don't know that depending on where you are and what your investors want. We report to our investors on a monthly basis. We do financials quarterly. We do an annual report, which I'm working on getting out now. And then we give like a monthly update to our investors. So I think that if you're communicative, like most of the deals we talk to them for probably three to 4 months before we put any capital in. And that's not necessarily because we move slow. It's just because we like to get to know them. We like to get to know the financials, if they have IP, checking that, things like that out. So over that timeline, if a company is constantly sending us like formal standard monthly updates, we're like, wow, the reporting here is pretty good and we understand what's going on. That's the one thing I tell all the portfolio companies is I don't really care if you have problems or challenges because I understand that every company has problems or challenges. I mean, it would be uncommon not to. We have problems and challenges as a fund. But it's important for companies to share those because, when we talk to somebody who's been out there trying to get funding for 3-4 months and they haven't received $1, we know that, but we just want to understand like, hey, why? Why do you think that is? What's been the common feedback? Maybe there's something you can change or tweak that'll, make us or one of the funds we invest with more interested. So I would say, I know there's a ton of platforms out there. There's Start Engine, there's AngelList, there's Crunchbase. I don't spend too much time combing them. I mean, there's PitchBook too. There's just so many of them. Most of our deals come from other funds that want co-investment or from our LPs. I look at everything that we get sent inbound too, sometimes from networking events like these where I like have a connection with the people before. Like I said, I just don't have the time to really go through those platforms. Our team's not that big. So I would say that, just important to value it and it depends exactly on who you're targeting. I would say it's kind of the best way to approach that.
Thank you. Makes sense.
I saw a question just come through on what's an LP. So the way our our fund is structured. It's a Delaware limited partnership. So all the limited partners are the investors in the fund. They own a piece of the fund when they subscribe for units in the fund. So that's just what we call them as limited partners. They don't really have any rights in the fund except rights to the profits and distributions, and all the investments we make and all the things we do, we're acting on their behalf. So I hope that's helpful.
Yes. And, always feel free to unmute and ask your question directly, Natasha, and anybody else. Questions? I know Sean always has something to say.
I have a question. Can you compare what happened at Goldman Sachs in assessing potential investment with the method or perspective you're using now? Do you feel that you're doing something different?
It is a bit different because the majority of the companies you're seeing there have cash flows and pretty substantial at that. So you're just doing a DCF value, a discounted cash flow valuation. It's kind of the gold standard in valuing companies with revenue for anybody who's not super into valuation work. Here, to the extent we get companies who come to us that have revenue, we can use a DCF model, but we're really valuing them on the growth. So it is a little bit different where we're trying to project forward growth instead of valuing the company on past revenue. That's probably one of the biggest differences, but it's just their checklist for evaluating the companies and you know what they look for has kind of helped us in shaping our process and shaping our due diligence. And you know, what are they putting in an investment memorandum? What exactly are they looking for in the financials? What numbers are, you know, the numbers that pop out to them versus numbers that they don't care so much about? You know, because if you're looking at a company's 10K, as you know, could be 80 pages of numbers, sometimes more. Which numbers are the ones that are important, and which numbers are the ones that are kind of like, you know, we don't care so much about those numbers. So like I said, I would say it's similar but different to a degree.
Well, I have a follow-up question on that. So I also come from investment banking background. I was in M&A and industrial coverage for a few years. So can you speak a little bit on how you actually do evaluate growth with early stage startups?
Yeah, sure. So if they have a market, if they already have a market established, a revenue market, so we kind of try to look at what their penetration is. So for example, we have a company that does delivery. They're kind of like the Uber of moving. It's called GoShare. We haven't invested in them yet, but we're evaluating them now. So they're in specific markets. So we're kind of looking at the closest competitors in those markets, like a Lyft or Uber, even though they're not quite the same, in quite the same business. And we're looking at the revenue that they're pulling out of that market. And then we're trying to value it that way. Like, hey, what's the total market in these cities worth? And what do we think their market penetration rate to get to? There's no like perfect science to do it. It's as you know from investment banking, it's much easier when you're valuing public companies or really large private companies who have a large market. So there's a lot of speculation, but that's the risk that you're taking on at these early stages. When you're investing in a company that's worth $20 million or $5 million, that's the bet you're making is that their growth is going to hit the benchmarks that you're modeling out for them. That's the jump and the leap of faith that you're making. And there's, we haven't had a company we've only been, in business for a year. We haven't had a company that's failed yet. But I can tell you the fail rate in venture is like 80%. So you can model everything out perfectly, think that the growth rate's great, have it modeled out to be a unicorn, and the company might only ever generate a couple $100,000 in revenue, and a competitor comes, or one of the corporates comes into the market with the same product and it just gets crushed.
How should early stage companies think about, you said you kind of looked at the total market. How can we go about researching TAM? What are can you give us any advice on how to do that if we're creating something new that doesn't exist out there?
Yeah, sure. So like I said, we try and pull from the closest public companies we can. So we use FactSec to get a lot of our data on markets. That's the only subscription we have for a database. So we can kind of look at the different markets that companies are in and how large those markets are. There's usually some degree of market research. There's probably, I know you said earlier that you're potentially looking to start a business in the electric car business or in the electric car space. So you could use, either legacy auto manufacturing or electric cars. What's Tesla's market? What's Nikola's market? What's Neo's market? What do those markets look like from the best data available that you can get, and say, hey, if there's X amount of cars produced, whatever the cost of what we're doing is, this is how it fits into the ecosystem, and this is the total addressable market. It's just really important that you have like a thesis that's defensible. I mean, I get that there's no perfect way to do it, but we see people all the time who are like, hey, I'm going to capture 1% of the total automobile market. It's like, how do you come up with that number? Like that's such an arbitrary number, where if there's a methodology behind it, that's the biggest thing with projections, is just the methodology. And, does it make sense? And then they can decide if it's worth the risk or not on an investment basis. But I just want to see like a good, strong methodology. So if you said, hey, look, we valued our business based on Tesla, they produce X amount of cars in the market, and we think that we could potentially be a vendor to them, and we could sell to them X amount of product for X amount of cars over this timeline. And then, there's the other market out there, and Tesla has probably, I don't know what their number is right now in electric car market, maybe 80%, call it. There's another 20% of the market out there, but we could get, our product into 80% of the market, and that's how we're going to value our business.
Can you just explain like your typical process when you're looking at a company that you might have an interest in investing in, like the steps that you go through? I know every investor has a little bit different, but there's a lot of similarities. So just wondering what you're looking at when you're evaluating a company.
Yeah, sure. So the very first thing that we kind of take a look at is obviously the founder. We want to know what somebody's background is, why they might be a good fit for that space. If you told me you were going to get into, the liquor business and you don't drink alcohol and you never have, it probably wouldn't be. I'd be like, well, I don't know where you're coming up with, why do you think that's such a good space for you? So it's one, the people, how is the relationship with the people? How's the dialogue with them? Do you enjoy talking with them? Do you enjoy working with them? I mean, ultimately, at the end of the day, we want to fund and we want to work with good people first and foremost. And we want to work with people who, have shown that there's a good chance they could be successful in a given industry because they're an expert in the industry, they have past experience in the industry, what it might be. And then we're looking at the idea. What's the idea? What problem does it solve? Like I said, our thesis is we want something that changes an industry. Like I don't want, to use a simple industry and somebody who's a pen manufacturer, right? I wouldn't invest in somebody who's just like, hey, look, we have a pen that writes better. That's not going to change the industry. It might make money, might be a good business. It's not going to change the industry. I want companies that are going to change the industry. For example, a company in our portfolio, ZeroWise, they're based in Philadelphia. They're really an AI company, but they do software overlays on security cameras so they can identify weapons on somebody's person in a school. That's their main target. They sell to schools. So for us, when we saw it, I've done the demo, I've done the technology, that's something that's life-changing, right? You could go to every governor or politician who said they're serious about stopping school shootings, and for a low cost, you say, hey, we have this technology. So if a gun comes into a school, we're going to know about it right away. And even if we don't know about it right away, God forbid somebody starts shooting, we're going to know who they are, what type of weapon they have, and where they are. And from a lot of the research the ZeroWise guys did on active shooter situations, one of the ones that, that still resonates with me is the Virginia Tech shooting that was in, I think, 2008 or 2009. One of the things they talked about is the guy was, going from building to building for like 5 hours. Nobody had any idea who he was, what type of weapon he had, or where he was. So, it makes things tougher. So it makes things a lot easier for law enforcement to stop a bad situation, and hopefully it can stop them before it happens. And, we've been right on them so far. So we invested last February, it was our first deal. We invested at a $6 million valuation. We reinvested in September at 18. We just reinvested at the end of January at 25. So to me, that's a company that's like, wow, they're changing an industry. I mean, they're changing the security business, and it's having a real impact. So we want companies that have a material impact. And then, of course, the third part's the financials, right? Does it grow and scale? Does it make sense? Is there going to be somebody who's going to want to buy this in the future? What's the company's exit plan? I mean, I know it sounds like very venture capital-y. It's somebody who's put their entire life out there on the line to build a company, and you're basically asking them how they're going to get rid of it and make money off of it. But that's kind of our job at the end of the day, is to get returns for people. So I need to understand what somebody's plan is to turn an idea into profits for me and for our limited partners. And then it's, after those are the main three things. After that, it's more cursory due diligence. Do they have IP and patent protections? Who's on their team? How are they scaling their team? What do they need the funds for? What's the business worth? But those are kind of the big three things that we identify to get somebody to the point where it's a deal we want to invest in.
Well, I actually have a business that does change industries, but my only, the wall that I'm running into is the fact that we're just a newly startup company. And so I'm having to use my personal funds to fund it. And so I'm going to VC to VC to VC, but because we're such an early stage, no one is really interested. Do you have any tips?
Yeah, I mean, it's tough. I can tell you the two businesses I started, before I took $1 into Backswing, I probably put in 6 figures of my own capital, and into BX3, I certainly put 6 figures of my own capital into it. So I can tell you, starting in a business at any level is hard, and there's a lot of capital required on the part of somebody who's starting it. I mean, I had to spend money just those legal documents to get us set up were $60,000 plus. So there's a heavy startup cost on any business. I like to tell people to bootstrap as far as you can without, really constraining the growth or putting yourself in a bad spot personally, before you go out to the market and raise capital. Because once you go out to the market and raise capital, you're setting your price. So if you could get a business to a couple $1 million in revenue without raising capital, that doesn't often happen. But the valuation is going to be so much higher. So in the long run, you're going to own so much more of your business. So that's my recommendation. If not, I mean, if you're trying to raise capital, make sure you're targeting the right type of investors. Don't go to, if you're really early stage, go to some angels, some friends and family. I mean, I've seen companies taking capitals, as small as $1,000 increments of investment. I probably, in a perfect world, I probably wouldn't recommend it. But that's what some people do. And there's a big story of struggle and there's a big story of struggle for pretty much anybody before they get to success. So, that would kind of be my first step is, if I was really early, is targeting friends and family, targeting angel investors. And then, there's a lot more online fintech lenders out there now too, where you could get a loan, certain different types of loans, that are, either secured or unsecured with interest rates that are, I mean, I don't know the interest rates that well, but, rates are generally pretty low right now. So that's always an option too, but you just got to do what's right for you personally and, right for your business.
I know you mentioned earlier that you look for companies and you call yourself early stage investors with $1 million in revenue. That's high for many early stage companies.
Yeah, I think the highest in our portfolio right now is about 9 million and the lowest is about 800,000. So I like the $1 million in revenue number. Like I said, it doesn't have to be a hard number. If we found somebody, say, towards the end of the year who's doing over $100,000 in monthly revenue, so they're not, they haven't achieved $1 million in a year yet, but their run rate is getting there. We'll take a look at that. So oftentimes we'll invest in companies who have actually accrued less than that, but their ARR is going to be above that based on the last one to three trailing months. But I mean, like I said, there's so many deals out there that are good ideas, but for us, it's about having a thesis that's defensible. And as I mentioned, we saw probably close to 1,000 deals last year. So, we have most venture capitalists are seeing, some are probably seeing more. I mean, that's just me. I can imagine Sequoia or an Andreessen Horowitz, they probably see that in a month. So they have, they have the luxury of just being really selective and sitting there and only investing in the best of the best deals.
Thank you. I'm actually having my breakfast. Anybody, next question?
Yes, I want to ask Kyle, if someone was interested in having you take a look at what they have, what would be the steps in order to get in contact with you for that?
My personal cell phone and my email is right on the website. So I get a lot of emails. I kind of pride myself on responding to every deal that gets sent to us one way or another, because I hate when I'm raising capital and people don't respond to me. I don't ever really think no is a bad answer. You usually learn from the feedback. I mean, in the fundraising process, we have about 40 LPs. I probably talked to 120 people. So that means about 2/3 of them said no, and about 1/3 of them said yes. But from the 2/3 of them that said no, I learned a lot from them. Hey, I would like to see this. I would like to see that. I mean, a lot of them just want to see a track record because they have different investment options that have a track record. But I respond to every deal. I always give people feedback. I mean, obviously, if we invest, we know it. If we don't, if it's simple as somebody sends me a deck over that's just not good, I'll just respond to them and be like, hey, thanks so much for sharing this deck. I just went through it. It doesn't really give any overview of your business or, why this is a good solution. So, feel welcome to send us an update or, follow up in a few months. But for right now, we're going to pass. It's sometimes as simple as that. And sometimes, we get down as far down in due diligence and it's, hey, you don't have your IP protected or you don't own, you have a software development company who owns all the technology and the product. So like, there's a really limited value of the business because you don't own the most valuable part of it, which is the technology. So all sorts of different reasons we pass. There's all, like I said, there's all sorts of different reasons we'll pass on a deal, but yeah.
Would it make any difference if they referenced having been here at the breakfast?
It's certainly somebody I know who's out. Like I said, you learn a little bit more about a person every time you talk to them.
Right.
So you're saying, hey, you know what? Somebody's taking the time on a Thursday morning to listen to you speak. And they're out there getting involved with this group and probably other groups. So they're probably passionate about doing things the right way and building their company. So yeah, I think that's certainly something you take into account is where you meet people. I value the deals a little bit more from something that comes like this or something that comes from an LP than from, somebody who emails me off the street that I've never talked to before and know nothing about.
Okay, thank you. Anybody, next question?
Yeah, I've got one. What are some of the sort of typical mistakes that you see founders do that you try to help them navigate avoiding?
Yeah, I mean, the most glaring thing I see is, or a couple of things for me. We invest in healthcare technology a bunch. I'm not an expert in healthcare technology. That's not my background. My background is finance. That's what I really understand. We have subject matter experts who review the deals for us, but some people are really not good at breaking their deals down into terms they can understand. I mean, we don't do biotech, but I've spoken to I spoke to some people with biotech deals. Some of those people are just so smart and their products are maybe really good, but they're not able to break it down to a level that I can understand. So it's so tough to me to go back to my limited partner advisory committee or my partners or investors and be like, yeah, we invested in this deal. And, I get asked about it. Why'd you invest? Tell me what they do. If I can't explain to them what a company does, you could probably understand why it's pretty easy for me to say, hey, I can't invest in this. So that's mistake number one, is just being able to articulate it to somebody who knows nothing about your industry and moving up from there. Because people get lost really early on. And then the second is on the financials. Like I said, I was saying that to Irene before, people just don't have a good thesis for their financials a lot of the times. A model can look really pretty and perfect and, all the numbers tie out, but it's not based on anything other than, just their opinions. And like I said, I know it's not a perfect science, but I want a model that's thoughtful and thought out, more so than something that looks fancy. It could be 12 rows, but if it's got a lot of information and it's got, good sound reasoning behind it, those are probably the two biggest things. People overprice their businesses a ton. We just invested in a company, Sunray Technologies, based in New Jersey. They do 1.6 million in revenue. Their valuation is 6.7 million. I see companies with no revenue and a product that's in beta who want, a 5, 10, $15 million valuation. And I point them to an example like that. Like, these guys did 1.6 million in revenue last year. They're growing over 50% a year. And their only value, their business is fairly valued at it's probably a little bit cheap. Probably could be closer to 10. So it's probably a pretty good deal, but their business is valued at like 7, 8 million. I mean, we get people who just on the valuation, they're just like, hey, no, I want capital at, 20 or 25 million. And they have these numbers in their head based on, these massive exits. And that's just not reality.
Yeah. And for, for companies like mine, for instance, who are pre-revenue, and you're obviously making projections, right? And you're trying to be as sound as possible in the assumptions that you're making. What are some of the pitfalls that you usually see founders sort of fall into around making these early projections on the revenue model?
Sorry, can you just repeat that?
Yeah, I was saying for pre-revenue startups, where your financials are based solely on assumptions that you're making. What are some of the pitfalls that you see founders sort of fall into, or shortcomings around those models that sort of tick you off?
Like I said, the biggest thing is them probably just not being realistic. You saying that you're going to do, 500K and, in revenue from zero in 3 months, unless you have a medical device or a product that just went through like a regulatory approval that's coming online and you already have contracts and sales lined up, it's probably not going to happen. It's not going to work out like that. So, I mean, I think that's kind of the biggest thing. I think that's kind of the biggest thing is just things have to be realistic.
Then you have the outliers. It's like, all right, I've been on for a Clubhouse for a few months, and I got an early invitation. And, when I joined, it was a little under 100,000 people, and 2 months later, it's 2 million people. What are the revenues? Probably zero or very low. And yet they just raised 100 million. What about those outliers? And it's based on traction rather than revenues.
Yeah. I mean, that's a different sort of game than I play into because I'm just at such an early stage. I kind of called that the Softbank Effect. I mean, look at WeWork. I have no idea how much in capital they raised. I mean, but it was they took in billions of dollars in capital. And I know they're still around, but the business isn't very solvent. So I kind of called that the Softbank Effect, where all this, I don't want to call it easy money, but all this money just rushed into these ideas. And a lot of people got hurt. I think on Uber and Lyft at the end, some of those investors who came in right before the IPO lost money. The stocks are performing a little bit better now, so they're making money in the end. But like look at WeWork as an example of that. That doesn't necessarily, what was I forget the name of the company, but it was a film startup. Meg Whitman from eBay was one of the founders of that. Quibi, yeah. I mean, look at them, 2 big name billionaires, people who have been super successful in business. I think they raised $150 million, and I think it ended up giving it all back to their investors because it didn't work out. I mean, they raised $150 million just basically on their names and, picking up the phone and calling some people.
Adrian actually took the question I was thinking about asking, but one of the dilemmas that we're looking at is, our system is going to have users and what we call producers who will start the project. And we're toying with, do we want to just have a lot of users using it for free? Or the thing that we're kind of leaning towards is having the producers who would be starting the project, paying maybe a monthly fee or a yearly fee, and then everybody they invite to take part of that as using it for free. Because obviously we want to try to build up users as well. Because right now we're not making any revenue at any point, and we're actually not ready to make the revenue. But I'm just getting your view on that and how you feel about it.
Yeah, that's interesting. We're evaluating a company right now. It's called the Buildsters. They do a construction podcast, but they're really like a media company in the construction and home improvement space. So one of the things they did that I think is pretty interesting is on their free, he's charging people already. Everybody who comes on the platform, he gives them a 1 month free trial. It's $99 a month. So he gives them the first month free. And then, one of the things we're really interested to see is he just added a bunch of new people is his conversion rate. How many of those people see the value in the platform? Because, there's a good chance that some of those people may or may not see value in the platform. So that's one of the things that's interesting is like, as an investor, if you give something to everybody for free and you have this great user number, that's great. But if you're going to like the gold standard of valuing revenue per user, you go to somebody like Facebook, because nobody monetizes their users better than Facebook. So I'll sit there and look at it and be like, oh, this is a really good idea. You have a lot of users, but it's like, how much money do you make? And then it's like, well, the $1 million question is, once you start charging them, do they run from the platform? I hope the case would be no, but that's something that's interesting to see.
Yeah, that's sort of the thing that we're looking at is because, you can always use like advertiser based and try to get advertisers on there to make the money. There's the way like YouTube or I guess in Facebook does. But, we're not sure that we want to just try to base it that way. We think we'd rather have people who really believe in the product and see the value in it and be willing to pay maybe a monthly fee or a yearly fee to use it. So the serious users. And then, of course, on all their projects, everybody who's participating are essentially also users because they're using the platform. And then maybe they'll get interested enough that they'll want to be a payer to become a producer as well. So thank you. Appreciate it.
Next question.
Hi, this is Kyra. I just wanted to get your thoughts around crowdfunding, because that's something that seems to be pretty these days, especially with Dawn Dixon of Popcorn. She raised her first $1 million, and then just this week, Arlen Hamilton and Backstage Capital raised $1 million in 9 hours, and that just broke all records on Republic. As Christina was speaking about the option to early stage, crowdfunding kind of came to mind, but I do know that some more institutionalized investors, they frown upon crowdfunding because of the fact that, evaluations are set so high on these platforms. So I just wanted to get your take on it personally, and then even for the founders who don't have another option, what is some advice that you have for them in terms of not setting their valuation so ridiculous on these crowdfunding platforms so that it hurts their efforts in future rounds?
Sure. So I think that if you have a consumer product good like Popcom, I'm familiar with them, it's a good option. It's a good option. If you have something like, a water bottle, or like, who did it? I think Drake did it with one of his whiskey brands, did a crowdfunding. If you have that kind of built-in, influencer-driven consumer product good, I think that Reg CFs are an awesome option for you, because people can get the product and invest in it, because it's really your user base of the product who's buying it. I think that's a really, really good alternative in those cases. To the extent you had like a high growth technology company or somebody like a ZeroWise, I don't know that a Reg CF would be the right option for them. But for somebody with a consumer product good, I think that a Reg CF is a good option. I know there's a lot of folks in venture who don't like it just because it muddies the cap table. I mean, you're going to bring in, hundreds of investors. So when you go to a cap table at a later round, but it's important how that's structured. Are they, is whoever's doing the Reg CF, are they creating an entity that those people are investors in, and then the Reg CF platform is the investor in your business, so you don't have 1,000 people on the cap table? Or is every person on the cap, every person who's an investor, an individual owner of the business? Because if I see a cap table with 1,000 people on it at $100 each, it's going to make my head explode, because it's going to be just so hard once we have to do a distribution or move to the next funding round.
Yeah, I can actually speak to that a little bit, because we're B2B software, and we did Reg CF raise last year, and they do, at least at Republic, which is where we did it, they consolidate all of the entries as one line in your cap table, and they kind of are the intermediary. So that's helpful. But you don't have some of the synergies you would have as a B2C thing, where your customers are your investors. We ended up probably with a few customers from the round, but we had like 410 investors, and I doubt more than a half dozen of them are potential customers. So it has to work. It has to be a fit. But actually, I can speak highly of Republic in that they have a good screening process, and they really try to make sure that every entrant, every crowdfunding round that goes live has a good shot at success. I think 90% of theirs raise money. And I know some of the other platforms are not as kind of picky, and therefore it's more like a 50-50 thing, where you might raise money, you might not. So anyway, if it's done right, it can work even for B2B. But I take your point. It's definitely better for B2C.
Yeah, I think it's easier to value the products that way. I think generally it's just a better, I think that's the best mechanism for it. So if you have a good that's going to consumers, or you have a built-in product audience, I think that it's a pretty good alternative. Outside of that, I think it's tough.
Yep, I'd agree. Having done it, it did work, but it was tough. On the other hand, the other thing I should mention, I'll let it go. The other thing is it's a very undemanding line in the cap table. Like, the folks that are there just thrilled to be there, and they're excited to be investors, and it's like having a cheering section. So it is kind of fun, actually. You know, and the demands are pretty light. That's one thing that's surprised me. It's like they're all just psyched to be on board for the most part.
Yeah, which, like I said, which is great to have in any cap table. I can tell you our LPs are pretty, I don't want to call them laid back, but our LPs are pretty relaxed as well. You know, our LPs are pretty relaxed as well, which is good. I mean, when you're dealing with the right people who understand the space, they get it. That's one of the reasons, you know, people don't really understand the why on the accredited investor rules. And I'm not saying that I love the accredited investor rules myself. However, I think there is some prudence there that helps people from unknowingly taking capital from the wrong folks. I mean, again, if you take, you know, $5,000 in capital from someone who's making $50,000, right? That money to them is huge, where it could be such a small fraction of your cap table. They might be the one who's constantly on you about getting a return, and they just don't understand how it works. Where you have somebody who's, you know, worth $25 million and is an active venture investor, and they get that these things take time. So as long as you're, you know, transparent and honest, and you're reporting to them on whatever your annual or, you know, semi-annual quarterly cadence is, you know, they're fine and they're there to support you.
Cool. Oh, and by the way, thanks so much for the transparency of having your email on your site. That is like, you're going to do really well just because of that, just because people feel like you're accountable, because a lot of places that, you know, the managing partners just kind of hide, and you know, it's just weird, the kind of song and dance that you have to go through to actually get a hold of people. So I really appreciate your doing that. It's really cool.
Thank you.
And founders need to know that they need to vet their the investors as well, just as the investors vet them, because not all funds are the same, and they should do their due diligence about the funds as well.
Yep. Yeah, I've heard horror stories from different portfolio companies. Well, not companies that ended up in our portfolio, but we get that. We get those people who reach out to us every now and then that they're like, well, we have capital. And it's like, well, why are you raising more? It's, well, you know, our investors hate us, and we hate our investor, and, you know, we have a bad relationship. It's like, I feel bad when I see that happen, but people think, you know, we want to come in and buy out their investor. And like, that's typically a really sticky situation, because, you know, it's, again, we have so many options. The last thing I want to do is put myself in a bad situation, and distressed finance is a stressful situation.
In fact, before he founded Founder Institute, Adeo Resi had this site, and it was people giving feedback about investors. There was a rating system, and people were very honest about their investors and how they were treated, good and bad. It was fantastic, but it really upset the investors, and he did take it down.
Yeah, and the networks that deals, I mean, there's probably less accountability for investors than there should be, just because they kind of hold the power. I mean, these companies need capital. The investors need deals too, though. And if you develop a really bad relationship or a really bad reputation as an investor, it'll come back to you, because eventually you'll go into a market or, you know, an accelerator or an incubator, and you'll be interested in a deal. And, you know, you'll just get hit with, hey, you know, I heard what you did to these guys. I don't want you to have any part of my company. And, you know, that's usually the wake up call for most investors. You know, it's like, man, we dealt with these companies really the wrong way, and they hate us. And like, now we got to look at look in the mirror and see what we did and figure out how we can do it the, you know, right way.
In fact, we had David Arcara from Laconia Ventures, and he was warning about just this. And he said, people will say that getting into bed with an investor is like a marriage. And he said, it's not. Because if the marriage doesn't work out and you can get a divorce, he said, you are stuck with that investor for the life of your company. And that's great advice, and it's true. I'm sorry, any questions or comments from the audience?
Yeah, I do have a couple of points that I took a good note of. It might take us back to the personal growth and how Kyle have shifted from being a founder to going to the investment side. But you talked about process and structure that helped you, you know, make that leap, you know, from being a founder to investor. What would you advise founders not to become investors, but to use these to process and structure to grow their own businesses, and if there is current tools or books or resources that can help in that.
Sure. I can say I honestly don't read a lot of books. I probably haven't read a book since college. I'm big on reading like current events and keeping up with the news and trends. I parse through Crunchbase, and I read PitchBook's Daily Update. I read a lot of newsletters, Morning Brew, CNBC. I'm constantly reading to know what's going on, et cetera. But I mean, I'd say reach out to people. So if you're starting a company in a given industry and there's an established leader in that industry already, just reach out to them. I mean, most people who are, good people are there to help. They're there to help you. They're there to share their knowledge. They're there to share resources. That's kind of what they're there for. So I would say there's a lot of value in just, not being afraid to reach out to people. Again, if you're starting a bank, reach out to somebody who's pretty high up at, a Bank of America or Goldman Sachs or JP Morgan. If they have the time, I'm sure they'll get on the phone, but it doesn't even have to be someone that big, but just reaching out and just trying to get somebody's experience. Like I said, most executives are people who have, founded major companies. They went through a struggle or perhaps multiple struggles, or, there's been parts where they've leaned on people for guidance. So like I said, if they're a decent guy or girl, they'll help you and at least share some insights, if not make some introductions or, do more, but, at least have a conversation with you.
Yeah, sounds good. Thanks.
Another question? I know a lot of places are in lockdown and you're not even in supposedly your hometown. So I wonder what geolocation means in terms of investing right now, and will that change once things open up again?
I think it's more about a product of who you see. So for me, if I'm in Philly or New York, I'm probably going to networking events and having meetings with other people who are in Philly or New York. So I'm seeing a lot of those deals. So my pool of deals that I'm seeing is more Philly and New York centric, versus like right now, it doesn't really matter where you are geographically. I get pitches from people in California. As I mentioned, two companies, GoShare and BuildSearch, are both in California, by the way. And it's not to say that we wouldn't invest in deals out there. We have actually already invested in one deal in California. Typically just not Silicon Valley, because that's just a whole different resource. I mean, or, a whole different area. I can tell you that, going back to the deals that have raised like unicorn and $100 million rounds, the deals in Silicon Valley tend to have that characteristic that they can raise $100 million with no, basis in financials to support those numbers. Where if you're on the East Coast in New York, the valuations are typically much lower, because a lot of the folks who are venture players here are either people who have a private equity or investment banking background. So they just don't see valuing a company at, an infinite times revenue or infinite times profits. They just don't see that making sense. But yeah.
Thank you. Anybody else have a question or comment?
Yeah, I have a question around software development. So I just want to know if there were any software development companies that you partnered with when trying to help some of the companies that you invest in, or if you have a software development branch that is supposed to help with the technology stack of the companies that you work with.
No, we don't. If we go out into the market and somebody needs a resource, we like to have them choose the resource. One thing I really always want to be careful about is pushing certain vendors on a company in our portfolio. I want them to be really comfortable with their vendors. Of course, if it's a big contract or something like that, I would love to meet them and speak with them. But the last thing I ever want is for a portfolio company to use a vendor, have an issue, and come back and point the finger at us like something went wrong and they didn't have a say. They didn't have a say in the whole process.
Gotcha. Thanks.
Anybody else? Questions, comments?
I have a question about sort of your goals for annualized returns. Like, do you have a sense, obviously it's still very early, but do you have like a target you want to hit in terms of 3 years out, 5 years out kind of thing?
Yeah, so the one thing we're looking at, so we just got our valuation report and audit report done. our unrealized IRR in 2020 was 30%. So for us, that's pretty good. 30% over 5 years is about a 4.5x return, net of fees. So that's pretty good return. So that's where we kind of want to be, is somewhere around 25 to 30% an IRR on an annual basis. That's kind of what we're looking at, and the metric that we're hoping, supports us.
Cool.
Anyone else? I wonder if we should start these a bit earlier, because I'm noticing that some people had to jump off for other things. And I did ask people if it would be better if we started these at 9. But you can comment in the comments or in the chat. So if we don't have any other questions, I'm wondering if Kyle would like to leave us with some pearls of wisdom, either as an investor or as a founder, or dealing on either side of the table.
Yeah, sure. I mean, the biggest thing that's helped me is just working hard and not being afraid to reach out and put yourself in uncomfortable situations. And I mean that by reaching out to people that you normally wouldn't reach out to, and and doing things that you wouldn't normally do, and stepping out of your comfort zone a little bit. I do it on a daily basis, and that's what I would say is one of the biggest things that's helped me and made me successful.
I agree with that. In fact, I wrote a newsletter once called No as an Acronym, because I noticed when I was a kid, before I even knew the word acronym, that you'd always hear your parents say no, N-O, no, but they would never say Y-E-S, yes. So I realized there's something to this no, so just change the talking points. So, I came to realize later that no is an acronym that stands for not ordinarily. Change the talking points and don't be afraid.
Sure.
The worst you can hear is no.
Exactly.
So anything else before? Maybe we'll end early today, unless you guys want to chat with that.
I was just curious on how Kyle felt his athletic background and at college came into play. My son played basketball, Richard Stockton, a little bit before you, and I think that helped him out a lot in his career. They used to play Arcadia, so I went to the games a lot of times. So I was just wondering how much impact do you think that had on what you do now?
Besides having come up with a name for your fund, of course.
Yeah, I saw. Yeah.
I am an avid golfer. There's really no hiding that. Like I said, I play a lot of golf. It's good networking. I mean, that's definitely helped me in being able to open doors. And, I'm a member at a course down here and a course in New Jersey. So on the golf background specifically, it's a really good network to be in, especially in the finance business, to be able to play golf and play it well. As far as lacrosse, I think athletics teaches you, playing a college sport teaches you about being competitive, always having a drive to win, having the importance of having a team and people to support you around you. And I think it teaches people a lot about schedule too, because when you're in college, playing a sport's like a full-time job. We're involved with our sport 4-6 hours a day. Plus you have schoolwork and any other obligations, work, etc. So I think it teaches people about balance. It teaches people about physical health, that's important, especially with everything that's going on right now related to COVID. So I think there's a ton of lessons from it. I tend to gravitate myself towards people who are athletes, just because we have a similar background and they have a similar drive to get things done. So I think it's really important. I can give you a Stockton anecdote too. I was a captain playing lacrosse from my sophomore year to my senior year. My sophomore year, we played Stockton at Arcadia. I think the first game was like February 20th. It got snowed out at halftime. It was the coldest day of my life. We weren't allowed to wear tights because our coach didn't like them. So I was out there and it was probably 20 degrees with a wind chill. It felt like 5 and just snowing sideways. I mean, we came back out at halftime. There's 2 inches of snow on the field. We ended up finishing the game like 2 months later, but that was one of the coldest days of my life.
Yeah. A lot of people don't realize when I talk to them, if you're not playing Division I sports, they look at Division II, or in his case, Division III, don't realize that the amount of work that gets put into it is still the same. It's year round. You're putting a lot of effort in, and you're doing this because you really want to play, not because you're getting any kind of scholarship. So it's a lot of work, and people don't realize that. They don't realize even the difference between like a D1 and a D3 might just, like a basketball, it just might be a few inches of height, not necessarily skill level. So I always admired people that could put that in. And I have a little story for lacrosse. I graduated high school. I mean, I'm pretty old, 1975. And I went to Drexel and I had the lacrosse coach for my gym teacher. And he asked me if I ever played. And I said, just with some friends around the yard. And so he asked me to come out for the team and they were going to start a JV team, which they didn't, but he said he'd carry me on the varsity team. But I was, you know, I loved lacrosse, but I was a commuter and stuff. So it just didn't work out. But it's such a great sport. Unfortunately, our high school here does not have lacrosse. They do have golf, but they don't have lacrosse. I think my son would have probably been better at that than basketball. So, but anyway, he's about the same size as you. So anyway, well, good luck. And I'll tell you what's really amazed is, as everyone else will say, that you've done this in such a short amount of time. So I suspect that you probably had kind of inherently, you know, financial interest and background and a good way with the numbers, which is sort of the way I am. When it comes to art, I have no creativity at all. So, but anyway, but thanks for taking the time to do this today. It's really appreciative of myself and everybody else.
So are you since you started about a year ago, are you getting ready to raise fund 2?
So we are closing Fund 1 out at the end of this month. We left it open for 12 months. As I mentioned, we had our first deal issued a term sheet for a potential acquisition. So I want to get a little bit of capital back to our investors, but towards the end of this year, yeah, I think raising Fund 2 becomes a real reality and something that we start thinking strongly about.
How much are you planning on raising for Fund 2? Any idea?
I haven't really figured it out yet. I think it really depends on the early returns on Fund 1, because I mean, raising Fund 1 was all about relationships and trust and people who believe in me and believe that I'll be a good steward of their capital and make the right decisions and surround myself with the right people. Fund 2 is, you know, almost based exclusively on returns. So, you know, at that point, I'm getting my audited returns from RSM and going to, you know, more institutional investors, pension funds, endowment funds, and saying, here are the audited returns on, you know, Fund 1. And now you're just making a bet that I can, you know, improve on or duplicate my performance on Fund 1, which, you know, in most cases should be doable. So that kind of changes the dynamic. It could be 50 million. It could be 100 million. I really haven't put too much thought in it yet. It probably will be less than. The only thing I have thought about is just until I have a higher management fee to kind of build out more of an in-house compliance team, I'll probably stay under 100 million in total assets under management, just so I don't have to register with the SEC yet. And then once I get closer, call it, you know, 85, 90 billion under management, the management fees will be a little bit more, and that'll give me some leeway to bring some people in-house so I can register with the SEC. So that's kind of my thought process there.
Okay, thank you.
Yeah.
So the people who would invest with you would be different than the people startups would be looking for to invest in, right?
For the most case, I mean, we had a super low minimum. We've taken checks, honestly, anywhere from 25,000 from an individual investor to $5 million. For a venture fund, 25,000 is pretty low. Most of them that I look at are 250 and up. But again, we don't have a long history and track record. So it's a lot of trust and relationships. And some of those investors who are in at that $25,000 level are actually some of the most valuable investors you can have, because they want to get hands-on, they have industry experience, they want to help you evaluate deals. So that's kind of how we look at it. So, I mean, like somebody who's, maybe some of the larger family offices who are LPs in our fund, they might be a good fit for like they might be a good fit to invest in a much larger round or directly into a startup. However, an individual who's going to invest 25 or 50 or 100,000 probably wouldn't be, just because it would be the risk tolerance wouldn't make sense for them.
And are you going to include them the next time around as well?
Yeah, absolutely. I would never let go of the people who believed in us, from kind of what I call day one.
Thank you. So any other questions or comments? If not, we can end a little early. I know Kyle is going to be on the phone all day, reaching out to everybody he can. He would appreciate the extra 10, 12 minutes, right? So I want to thank you all for attending. We'll be here in 2 weeks with our next investor. It's Sapna Shah, who does retail tech. So I hope you can make it, and it'll be in the newsletter, and Kettle Space will post it as well. So thank you all for attending, and thank you so much, Kyle, for your time. We really appreciate it, and for your insights. And I love the Softbank effect. I'm going to quote you on that one, by the way. I was writing it down as you were speaking, so thank you for that.
Thank you, Kyle. Really. Yeah, that was very helpful.
Thank you for joining, and thank you for the questions. It makes it so much more, enjoyable, entertaining when people are asking questions. And, I'm thankful to have people who care about my opinion on this stuff.
Yes.
You're a Jersey guy like me, so
a lot of Jersey people here today.
Yeah.
Or as I like to call it, mythic New Jersey, since New Jersey happens to be the butt of so many jokes. So
yeah,
I try to spin it a little bit. So thank you all, and have a great day.
Thank you.
Sounds great. Thank you all.
Thanks, everyone.
Bye-bye.
Bye, everybody. Thank you.
Thank you. Bye.
Thank
Thanks,
you.
Bonnie.
Bye.